Welcome back to Down the Middle. I have to say I'm honored this afternoon that a fishing buddy of mine was willing to take a little bit of time out of his busy schedule to visit with us. I'm so pleased to introduce Charles Plosser. He really needs no introduction. He was the president and CEO of the Philadelphia Federal Reserve from 2006 through 2015. More recently, he's been with FINRA, the Financial Industry Regulatory Authority, where he has positions both on the investment committee and on the Finance Operations and Technology Committee. So I see you may have retired from the Fed, but you certainly have stayed busy. And I can see from the background all the papers. So I'm happy to see you're still reading copiously. So welcome. It's good. And if I can, I'm going to call you Charlie because that's what I've called you all these years. So
that's fine. It's good to be with you, Danielle. Thank you.
So I instead of you telling me a funny story, I'm going to tell you a funny story real quick before we jump into the nuts and bolts of Federal Reserve policy. So the afternoon in Maine, when the two of us were fishing in the afternoon, it was such a warm day that I decided to get into the lake. And what I never did tell you was I was so mortified because I could barely get back into the canoe that I ended up with bruises on the underside of my arms for 6 months that they did not go away. And I just remember saying to myself, this is the least graceful moment of my life is me trying to haul myself back into a 3-person canoe up in Grand Lake Stream, Maine. But that was a fun afternoon, and it is great to see you. There's a lot to talk about, so I'm just going to jump in. And by the way, do you still get to fish?
I didn't this year, so I do some, but this year, COVID kind of got in the way of a lot of things for us.
I think everybody can say that COVID has gotten in the way of a lot of things. Indeed. Well, I'd love for you to take us back to 2006. When you started at the Fed, there was a lot going on at that point. The housing market was just white hot, and obviously, on the West Coast, there was a lot of subprime mortgage lending going on. There was a lot of financial innovation going on. If you could just take us back to that time and walk us through some of the signals, some of the flags, some of the signposts that you saw in that era that started to flash red to you.
Well, I think you've got it right. The thing that was flashing red was clearly housing in 2006. I remember before I started having a conversation with some of my soon-to-be colleagues at the Fed, about interest rates, about housing, and both the role of the Fed, but also whether the Fed should or shouldn't be, so to speak, doing anything about it in some sense. And I think there was a lot of uncertainty and a lot of, I guess I would describe it as angst building up around the Fed as to sort of how serious was this problem, and what the Fed should do, if anything, about it. And that was right after I began at the Fed. And frankly, the first 6 months, it was hard. You just started getting your head around it and figuring out, being the new kid on the block, so to speak.
Sure.
What the right approach might be. So there were red flags. Well, I won't call them red. Warning flags, maybe, is a better way to put it, in those 2006 discussions. And of course, that began to change pretty quickly, certainly when we got into 2007. And further into 2007, it became, the flags didn't go away, and the Fed began grappling with sort of what what our roles should be in that environment.
Back then, the Fed was only involved with what we call now, I guess, conventional monetary policy. The interest rate lever was, kind of the main tool that was used. And I'll just jump straight to the question. I'm curious about whether we truly needed to go to the zero bound.
I think that's a fair question. I think that my inclination at the time was certainly leaning against going there.
Mm-hmm.
I didn't see a particular benefit from being there. I would say that the zero bound, or what they call now the effective lower bound at zero, has become an obsession of the Fed and how to deal with that. And it has colored and shaped the entire way they think about policy. And so it's my view that I think that has not been entirely desirable.
Mm-hmm.
Nor is it how do I want to say, as important or as critical as some people make it out to be, at least in my mind.
Right. Well, the idea of the Bernanke doctrine at the time, it was kind of drawn up in late 2007 at the 2007 Jackson Hole meeting. It was the blueprint dictated that you had to get to the zero bound before you could launch large scale asset purchases, or what the lay people call quantitative easing, QE. Do you think that necessarily, that one should have necessarily predicated the other? And what were your feelings about large scale asset purchases?
Well, as you know, Danielle, I was never a big fan of large scale asset purchases.
Yes, you definitely dissented. I remember when you were dissenting, and my boss Richard at the time, you were both dissenting together. Yes.
I think two things is that for most of 2007, the emergency or unconventional policies we adopted, some of which there was the TALF, and then there was other sort of discount window and primary dealer lending things that we tried to put in place in 2007. The fact of the matter is that virtually all those efforts were what we would call sterilized. That is, the Fed financed those by selling treasuries. And as a consequence, much of that early stuff in 2007, through most of 2007, was not expanding the balance sheet. Indeed, in fact, the balance sheet stayed pretty flat through most of 2007, and even into 2008. I think that what happened was two things. One is, particularly after Lehman Brothers, the Fed could no longer sterilize. It was running out of treasury bills to sell. So there was going to have to be, and certainly I would guess in Ben's mind, there was going to have to be a change in the way we did things if he wanted to figure out a way to provide more accommodation. And the balance sheet was going to have to grow. And then the question came about, well, how would we do that? And also, how do we control it once we do it?
Exactly.
And that was a huge debate about how to go about doing that. And I don't know that it was so much being at the lower bound. The lower bound was kind of a reason to want to do more accommodation and to figure out a way to do it. But remember, particularly in late 2008, after Lehman Brothers and so forth and so on, most of the Fed's efforts in those early days were really about stabilizing the markets and the functioning of the markets. And that's what came to be known as QE1, right? And I had some problems with that, but not a lot. QE1 were doing what I think the Fed should have done. We did it, magnitude of it, but it was seeking to stabilize markets. But after, I don't know, say March or April of 2009, it was done.
Well, that's exactly when that's exactly when the S&P 500 bottomed, was in March of 2009.
And so at that point, the Fed, in my view, the Fed had, in essence, accomplished that goal of stabilizing market functioning. It was what came after that was even more troubling. QE 2 and 3 and 4, or whatever, infinity, however, whatever the people like to call it. Those were the problems when the Fed switched from a market stabilizing role in financial markets to actually trying to use QE to provide more monetary policy accommodation. So there was a fundamental change in the rationale for QE that happened. And that rationale was what I opposed. I didn't think it was a very good rationale. I didn't think it was going to work. And I objected to moving from flooding the market with liquidity to solve a market functioning problem to one that says we're going to flood the market with liquidity to do monetary policy. I think it's interesting that many people who thought that was such a great idea back in 2008 and 9 and 10, many of them are now looking back on that episode. And I think there's a growing, maybe it's not the majority, but more people now are looking back and saying that really wasn't as effective as the Fed thought it was going to be. I think that's you hear people talking about this, and there have been papers written on it. And
you're right. When you look back at the transcripts of those years, you're right. There was very vigorous debate.
Yes. And, now I think some of the people, the Fed doesn't say this directly, but much of the research that's come out since then has now sort of said, well, yeah, maybe this really wasn't quite as powerful as the Fed thought it was going to be, or made it out to be. And of course, yet we're doing it again. So that's a different question. But I think that I do separate out both the motivation and rationale for QE1 from QE 2, 3, and 4. I just think they were just very different.
So it's interesting because you use the term rookie, and there was a rookie on the board who had only been there since, I think, June, and then I guess it was October, maybe 2013, maybe it was 2012, 2013, but it was when QE3 was being voted. Right. And a very new Jerome Powell argued very eloquently, given his knowledge of the financial markets. And the word that he used in the transcripts was that he was concerned that QE would become habit forming. And there were, maybe I need to get out more, Charlie, but it was one of the most fascinating reads was to go through that entire transcript again, because the debate was as spirited as it was, as revealed in those transcripts.
Well, I think that those of us who were on one side of that spirited debate, and Jay, I think if I remember correctly, was very polite about it, but I think we all worried, and if you have read them, you'll know that many of my comments through that whole period was about, once we start this, how in the hell do we get out of it?
Right. There was always that term, exit.
And do we have a plan to get out of it? Of course, many of the leadership in the Fed said, oh, of course we can. We'll shrink the balance sheet. We'll go back. And of course, it never happened.
Mm-hmm.
There's a whole lot behind that in terms of what happened with interest on reserves and the split between portions of the Fed that really saw this big balance sheet as a long run operating regime.
Mm-hmm.
And those of us who didn't like that idea for a lot of reasons. And so I think the evolution from the, what I'll call the old regime, what we call the Carter system, back before 2007, and that I think that desire to go back to that, there were people within the system and within the board who just didn't want to do that. And of course, that was related to interest on reserves and a whole bunch of other issues. So it's been quite a long, let me call it, evolution of how monetary policy evolves and works and operates. Mm-hmm. And I'm not convinced it's been all for the best, for the better.
That was said very diplomatically, very impressively indeed. So let's go to another thorny issue. Alan Greenspan once said that the ideal inflation rate for your average US household and company was 0%. And there was obviously years and years of debate around inflation targeting. So how did you feel about that 2% target?
Well, I think Greenspan's what said was that the price stability and the target for inflation, or the goal, should be inflation never enters into the household's decision making.
Mm-hmm.
In other words, that it was small enough to be irrelevant for decision making, which is not a bad way to think about it. It's kind of hard to figure out how to operationalize that.
Of course.
So I, from the very beginning, from day one, when I went into the Fed, was arguing for an inflation target. I mean, Ben had been too, for that matter. Mm-hmm. So I was very active in actually getting the 2012 inflation targeting statement written. I was deeply involved in that, and wasn't exactly what I would have written, but you got to get through a whole committee.
Of course.
But when I started off, I would have been happy with something like a 1% target instead of 2%.
Right.
But frankly, the importance of the target is having a target that you commit to. Mm-hmm. That's what's important about it.
Right.
And whether it was 1.5% or 1% or 2% was less important. Now, obviously, I wouldn't have settled for 4.
Right.
But the precise number was less important than the commitment. and they're willing to go public with the commitment. And so, yes, I would prefer something like a 1 or 1.5% target, but having 2 didn't bother me. And there was some advantage to 2 because, in fact, many other central banks around the world had adopted 2. And there's some rationale in an international context to have central banks on similar pages, if you will, in that regard. Not necessary. It's not really coordination, but it does, it would simplify things. So I was okay with 2. I would have preferred the CPI to PCE. All right. Only because
well, that's actually a big statement.
Well, the main reason for that was from a communication standpoint, the CPI was better known. And the really important thing about it is it doesn't get revised, whereas the PCE gets revised periodically. And so for those reasons, I leaned toward the CPI. I mean, the CPI. So that would have been my preference, but I was very happy that we did what we did in 2012. I think they've mangled it pretty badly in their August 2020 restatement of their long run objectives. They've kind of thrown out the baby with the bathwater, I think. But so I think the 2020 statement was a step back from our 2012 statement.
Interesting. So you were only out of college, I want to say, for 8 years when the dual mandate was added to the Federal Reserve Act. How do you feel about the dual mandate today, given it is causing its own source of debate among central bankers, because it is so difficult to target, to minimize inflation and maximize employment? And as we've seen, or at least in my view, it's caused the Fed to stay too low for too long.
So I gave many speeches on this topic, and let me take a step back. I think one of the most important features of a central bank is independence. Its ability to make monetary policy decisions as free as possible from political interference. But to have an independent central bank, independence isn't free. That is to say, for a bank to be truly independent, there must be constraints on the behavior of the central bank. In other words, if you ask a central bank to do everything, there's an old expression you've probably heard before, responsible for everything and accountable for nothing.
Indeed.
And what's happened to monetary policy, in my view, is that we have continued to expand the mandate and the reach of what we ask monetary policy and central banks to do. And in so doing, we are expanding their authorities, making them responsible for all sorts of things that they really can't do anything about. That really makes them unaccountable, because they can move their objectives around and make excuses for doing anything they want to do, which leads to a lot of discretion. I think that's a bad trend in central banking. I would prefer to see central banks. I gave a speech and wrote a paper one time called A Limited Central Bank, where a central bank is more targeted, independent, but more targeted and more accountable. And one way to help do that is to narrow the mandate, not to keep expanding it. Because the more you expand it, the more discretion you leave, and you make monetary policy unpredictable. And that, I believe, is counterproductive. So I think that and you may want to get to this later, but again, the revised statement that the Fed came up with last year was a huge step back and has now made the employment side of the mandate the dominant mandate, not price stability.
Correct.
And I think that's obvious, not just from their language, but when they said, we will not raise interest rates until there's full employment or something to that, full inclusive employment.
Full and inclusive.
That is just a statement that says inflation is of secondary importance to them. And so they flipped the mandate to the extent that price stability was the most important. And now they are holding themselves accountable for not just employment, but inclusive employment, whatever that means, for climate change. You go down the list of the expansion of the perceived mandate of central banks and ability on the institutions whatsoever, and therefore risk their independence. I'm sorry, that was a long answer to your question, but
no, but you bring up so many salient points, and you've actually written recently about this kind of mandate creep and the dangers that it poses. And I think I agree with you. I think independence is critical to the sanctity of the institution, and we're getting further and further from that.
Yeah,
that kind of brings us to this past July. We had the 70th year anniversary of the 1951 Treasury Fed Accord. Gentleman by the name of William McChesney Martin was involved in that, and I'm curious to see where you feel the Fed and the Treasury's relationship, how that has evolved over time, how that evolved in the heat of the onset of the pandemic, and whether or not we should anticipate increased coordination to better manage the nation's debt, or if we should be saying, you know what, let's look back to 1951. It was good reason that that those lines were drawn more starkly in between the two institutions.
Again, I would go back. I think clearly 1951 was an incredibly important time for the Fed. It really did secure its independence of monetary policy in a fairly clear way at the time, compared to the model where they were pegging the interest rate during the war and didn't have any freedom at all. And I would say that independence grew, but I think that how do I want to put this? It's going in the reverse direction now, and that's not healthy. I think the Fed is losing its independence, and let's just take. I talked about this back in the financial crisis, 2008 and 2009, 2010, and there I wrote several pieces and gave talks on what I call the separation of monetary and fiscal policy, how to restore the boundaries between those two. And I think there are boundaries between monetary and fiscal policy for a reason. And so one of the things that has happened that is sort of highlighting this dilemma or this challenge is the Fed's engagement in fiscal policy. Credit allocations, buying up non-treasury assets, trying to influence relative prices in the financial marketplace is all a game of fiscal policy. It's not monetary policy. That is dangerous for the Fed to be doing. They've been pushed in that direction, fair enough, but they've also willingly accepted the responsibility for relative prices in the financial system. That's a huge mistake for the Fed to be engaged in. the Fed needs to be as neutral as it can. In credit allocations, the emergency borrowing or lending programs in 2008 and 2009, and more dramatically after the pandemic, the lending and buying of corporate bonds, of making loans, that is not monetary policy. That's fiscal policy. The Treasury or the Congress, in response to the pandemic, the CARES Act and all the programs that got set into place that the Fed did, all of that could have been done by the Treasury. They didn't need the Fed to execute any of that. Mm-hmm. And that was a huge mistake, because now it's thought of as appropriate actions by the central bank. It's not. Those are fiscal bailouts, fiscal policies that the Treasury should have implemented. I mean, the Fed could have helped them do it. I mean, there's no reason technically, but they all could have been done by the Treasury. The Fed didn't have to do any of them. And that just drags the central bank deeper into the political process and into the conduct of fiscal policy. And I think it's sad that the Fed has been willing to allow itself to be drawn into that. It seems to have no interest in protecting its independence. And when the Treasury Secretary mentioned Mnuchin, they stopped those programs last year, if you remember the big debate.
Oh, yes.
Powell said, no, we have to keep them. We have to have this power. That's a sad statement about the Fed's perceived role in the government. And I'll make one more point. Sorry to ramble on here.
No.
But you allude to the fact that in much theory, economic theory and models, you do hear people talk a lot about coordination between the Treasury and the central bank, that's optimal policy in some sense. Well, yeah, maybe in some models it's optimal policy. But what those models don't understand and don't take into account is institutions. Carl Brunner, the famous monetary economist who was a colleague of mine for many, many years, served with him on the Shadow Open Market Committee, and as I edited the Journal of Monetary Economics that he founded, which I edited for 20 years. Carl used to make a very important point. He said to understand policy and recommend good policy, you have to understand the institutions. The institutions matter. And the way they're designed and the incentives that arise within the institutions because of the way they're put together affect the way policy gets conducted. Mm-hmm. And so when you want to think hard about policy, the notion that you have an all benevolent dictator, all knowing and all wise and all benevolent, to coordinate all this stuff is wonderful thinking, but that's not the way our institutions are set up. We have to understand those incentives and understand how people in those institutions are going to react. And so, so that goes back to this issue that why independence is important, why the Fed has to protect it. When they asked me several years ago when they were recruiting a new chair, said, what do you think the most important thing will be for the new chair? This was prior to Powell's appointment. I said, the biggest, most important challenge for the new Fed chair will be protecting the Fed's independence. Mm-hmm. And I guess I would say, so far, that's not going so well.
No, it's not. And in defense of the time when we were both inside the Fed, corporate bonds, municipal bonds, I mean, there were vigorous debates, and we as an institution then resoundingly rejected crossing that line. And I recall that there was a good bit of discussion about even becoming involved in mortgage-backed securities, because it really was a form of credit easing. It was a way that the Fed was targeting a specific sector. And here we are today with this gigantic debate about mortgage-backed securities and what's happened for the average U.S. household, entry-level home buyers who really have lost access to housing that has in many ways been fueled by the artificial repression of mortgage rates. I'm not sure how you feel about what side of that debate you fall on.
Well, I was never a fan of buying mortgage-backed securities. Mm-hmm. That's a form of credit allocation, which I am opposed to because it's actually fiscal policy.
Right.
Now, the Fed tried very hard to make it sound like it was really trying to do monetary policy. I mean, the problem again with go back to this big mandate they have, that big mandate and broad powers, they can make a case for almost any kind of intervention in the financial markets in the name of financial stability, the dual mandate. They can justify doing almost anything. That goes back to what I was saying earlier about the importance of having constraints on the range. Used to call it the range of authorities of the Fed. But the authorities keep expanding. The discretionary and willingness and rationale for intervening in markets gets expanded. And rather than being narrowly focused so that in fact you can hold the Fed accountable.
You know, I'll never.
Am I making sense here?
No, you're making perfect sense. You just reminded me of a story that I read about 18 months ago out of Tokyo, and the head of the largest stock exchange actually publicly appealed to the Bank of Japan to stop buying stocks in the market because the functionality of the stock market had become so hampered. And it goes to exemplify how slippery the slope is when all of a sudden you go from treasuries and QE1 and establishing financial stability to high yield bonds and stocks.
And corporate bonds. Well, yeah. And I mean, and everything, everything that I was worried about in 2010 as we embarked on this, it's all coming true. It's worse.
Right.
And I think that I have a sense in which, you know, the bigger the footprint of the Fed and the more engaged it is in intervening in setting market prices of various kinds, we've expanded the moral hazard problem of the Fed. The Fed's creating huge moral hazard problems. Why does it seem to be true that an $8 trillion balance sheet hasn't solved the liquidity problems when they used to be solved with an $800 billion balance sheet?
Right.
And why is that? Well, it's because, at least in part, my hypothesis is that as the Fed grows and displays its willingness to backstop and intervene when prices, in their view, become out of line, it means you get more episodes where the Fed feels like it has to intervene, and they have to intervene in bigger ways. Mm-hmm. And so rather than enhancing financial stability, my sense is, and this is debatable, but my sense is that we've actually aggravated it and created an environment where the Fed now thinks it has to intervene more often and in bigger ways. And I think that is, that's a debatable proposition, but That's my sense, and I don't think it's a good outcome.
I'll never forget Richard had me write an entire briefing document in 2010 about the implications of the default cycle, the credit default cycle in the corporate bond market being cut short by QE, and what problems that might present a decade down the line if the Fed had effectively kept companies in business that should have, in a non-intervened world, restructured and moved on. And now we actually have twice as many what we call zombie companies as we had prior to the pandemic. And now the corporate bond market is approaching $11.5 trillion.
Yeah, I think one of the language things that I find interesting over time, the notion of the central bank being a lender of last resort was created. It's a lender of last resort to depository and financial institutions, not everybody in the economy.
Exactly.
And it was a very narrowly focused concept. And going back to Badgett or Ricardo or and others, and it's always meant that. But somehow the phrase lender of last resort has now been co-opted to mean, oh, well, that means the Fed should lend as a last resort, or perhaps even the first resort, to anybody, any company, in any market. And that's just a bastardization of the term.
Yep.
And is inappropriate. And yet people seem to now use it in that light. And I think that's really unfortunate.
I'm not sure if you have any views on some of the international facilities that have been set up to really ensure liquidity. Swap lines have been set up. Do you think that in the end this will have any effect on the demand for U.S. Treasuries? And I would take one step further, and I'm not sure if you've been following this or not. It's kind of arcane. It's kind of an arcane subject, but the idea of the central clearing of Treasuries and kind of this path that we're going down when it comes to ensuring the liquidity that dried up in the Treasury market in March of 2020 to ensure that doesn't recur.
Yeah, some of this is pretty arcane. You're right, but I would say the following as a general proposition. I'm a believer in letting prices serve their purpose, which is to signal scarcity or surplus or whatever. I think this is another example. And I mean, I understand the Fed is very much, and central banks very much committed to and feels it's important to keep particularly the Treasury market functioning smoothly. I'm really not opposed to that. But I am opposed to allowing that concept to expand ever wider into other markets, because that's where the moral hazard comes. And that's where why you have episodes like, what was it, September of 2019? You have these flare-ups because the Fed has committed to intervening in all sorts of markets. So I guess I want to use the Treasury central as an example, so that you have to be careful how far you push these concepts.
Right.
On the international side, once again, I supported the swap lines during the crisis. I wasn't going to draw a line in the sand over those. I think that they were useful. But unlike some people, I didn't think they came without cost. And, the ECB has plenty of reserves, dollar reserves, it could draw on to support European banks in their dollar-denominated demands. We didn't need to do a swap line. We just saved them the price.
Mm-hmm.
I mean, it could have been handled, I think, by certainly the ECB and probably the UK as well, and Japan. Maybe some of the smaller central banks around the world that could get access to those swap lines, maybe that was appropriate. But I do think this tendency to treat everything as a crisis that calls for some intervention. Prices move for a reason. And if you don't let them move, then the reallocations that have to occur don't happen. And so I'm very much a believer that even in the financial markets, that the Fed needs to let the price system work and to stop believing that we know what those prices ought to be and to justify intervention on the grounds that we can get them right. I don't think we know what they ought to be, much less get them right. And that's what the price system does. So I have a bias, and I'll admit it's a bias, to letting those prices move. Frankly, Danielle, we're talking about the efficiency of monetary policy. If a repo rate spikes 15 percentage points for one day, I don't, as a monetary theorist and a monetary policy maker, I don't care. It
Right.
won't make any difference to monetary policy.
Mm-hmm.
And so I think we're too quick to jump
Mm-hmm.
and to think we have to do something about it. And there's huge pressure from financial markets to do that, as you know.
Oh, yes.
Traders and others want their backs covered, but that shouldn't be the role of the Fed.
No, you know, when I try and explain to a layperson, and I don't even understand all of Zoltan Pozar's old map, I've still got a copy of it. It takes up half of a wall.
I don't understand it all either. So
Okay, there you go. But when I try and explain to people the magnitude of this reverse repo facility that was $1.6 trillion today, an all-time record, I try and paint them a picture of a bucket. And I say, well, the Fed's trying to fill up the bucket from the top with $120 billion of purchases every month. But yet the larger the reverse repo facility gets, the more holes are being drilled into the bottom with liquidity being drained out. And the comment is, well, they're only overnight facilities. They go away in 24 hours time. But once you start to get past $1 trillion, and now we're pushing into 2 trillion, and they're constant, you say to yourself, well, okay, the Fed has clearly become a major player in this corner of the market. And now they have a standing repo facility in the event that the late 2019 events occur once again. It just feels like at some point the Fed's going to be the entire market.
Well, I have some sympathy to that point of view. It's a little bit like whack-a-mole that,
Yes.
you know, and every time you whack-a-mole, you expand your power and intervention capabilities. Which is back to what I said, why I think that this practice may in fact be contributing to volatility and instability rather than enhancing it. And that's a very difficult concept for some people to get their head around, but I believe there's some truth to it. And so it's quite troubling to someone like me who has spent most of his life in economics, being an optimist and believing in the power of markets to work and resiliency of a market economy. to see us heading down this path that is very risky at a minimum, as far as I'm concerned. And yet the train seems to be, barreling down the tracks to what may be a very unpleasant conclusion.
So there was, in 10 years before you joined the Fed, transcripts started being taken of FOMC meetings. And if you look at a graph that the St. Louis Fed produces on a normal basis, dissents on the part of governors pretty much fell off the map. And dissents on the part of Federal Reserve district presidents started to increase. In fact, when you and Richard and Honig and you guys were the Mavericks. You were that was an era of dissents that we have not revisited again.
So yeah, I think this is. I wrote a Wall Street Journal editorial in 2015, shortly after I retired. And with editorials, you don't get to pick the title. The editors do that for you. But the title was "The Veneer of Consensus," and I made this point that, in fact, between 1976 and 96, you had about, these are just round numbers, 100 dissents over that 20-year period by governors, and about 100 dissents by presidents, about equal balance. Not quite, but between 1996 and today, there have been about another 100 or so dissents by presidents, 2 by governors, 2 in 25 years.
Mark Olson and, oh my gosh, Mark Olson and I know him, we're good friends. I've seen him in Dallas. I can't think of the second one. But Mark Olson was the last one.
He was the last one. That's a tremendous change in the culture of the institution. And we can speculate as to why that's come about. Markets complain, well, if you dissent, you're undermining the chair, or we want unanimity. Well, how can you have unanimity of 19 smart people sitting in a room facing a crisis they've never faced before? If you've got unanimity, Walter Lippmann, the journalist, once said, where all men think alike, no one thinks very much. And the fear that has been, or concern that has been placed on governors in particular to not dissent, I think is a bad idea, is wrong. The MPC, the Bank of England's Monetary Policy Committee, is much better at this. Mervyn King, I talked about Mervyn King, actually lost votes occasionally during the crisis, 2008 crisis. That did more, his willingness to lose a vote did more for the credibility of the institution than anything. He said, this is a decision by an institution. And we have a committee because we get better decisions that way. That strengthened the institution. What's happened in the Fed is the pressure on governors not to dissent, so that it's always unanimous or strongly, runs counter to building the credibility of the institution. And not only that, it's not transparent. The value of dissent is that it makes transparent the nature of the debates and the issues the committee is facing. That's transparency. And to hide that transparency under sort of a consensus statement that's crafted to get everybody on board, I believe is dishonest and counterproductive. And I think that we'd be better off trying to change that culture if we could. And I think some of my colleagues and even past chairs I've talked to about this understand that. But once you get in the seat of the chair, it's hard to do that. And it also means, back to transparency, that means the statements that come out by the Fed are not very informative.
Mm-hmm.
Because they're trying to get everybody to agree on this word or that word in order to build as large a consensus as you can. And that gradually takes the content out.
Right. No, I mean, when you read through transcripts, you can read through pages and pages and pages of debate on one word. And you say to yourself, is this really happening? These are grown adults here in this room.
Well, it's happening because they want to build unanimity or consensus.
Yep.
Consensus is, I'm not against consensus when it's there.
Right.
What I'm against is building a consensus and hiding the debate in order to make it a consensus.
Right. Right.
Wrong.
No, that's a critical distinction. So tell me where you think we are with the big inflation word right now. Because it is one of the most hotly debated subjects, and the whole transitory, persistent supply chain. I mean, at last check, a rent is 12 months in length. So if rents are rising at 10% year over year, which they are, to me that seems like it's a long. It might feed through with of course with a lag, but that it might feed through into inflation for a persistent period.
Well, yes. So I think the issue is, or the number of issues. I don't think there's any question that some of this is due to bottlenecks or supply constraints. There's clearly some of that. I'm not denying that.
Sure.
But in some ways, that's not the interesting question. And the question that I see the Fed avoiding is answering the question of, well, what role does policy play? In other words, my view is that whether this spike in inflation turns out to be more persistent, that will be determined not by the price of lumber or the price of rents or used cars. That's going to be determined by policy. That is, if the Fed and the fiscal authorities, we're in the most accommodated state in 100 or 80 years anyway. And to me, as a policymaker, I would be deeply, and am deeply concerned as to whether or not my policy actions are going to determine the path of inflation. Look, people don't like me or other people raising the 1970s. But what did we do in the 1970s? We had big fiscal deficits from the Great Society and Vietnam War. We had oil embargoes, supply shocks, bottlenecks that were caused by the scarcity of oil and the price of oil. What did the Fed do? The Fed tried to keep those supply shocks from adversely affecting unemployment. It kept monetary policy very easy, even tried wage and price controls. But in the end, they took those transitory shocks and supply shocks, increased monetary policy and aggregate demand through monetary policy, and translated those supply shocks into more persistent inflation. So the question they keep saying, well, it's going to be temporary, it's going to be going away. That's not what I want to hear from the Fed. I want to hear how is their policy going to make sure that it's transitory,
Right.
rather than making sure it's going to be more persistent. And the Fed does not like answering that question. And every time you've heard Powell talk about it in a press conference, he says, "Oh well, it's the price of lumber, or the price of automobiles, and it's going to go away." Well, okay, what does that tell me about? What does it tell you about what you ought to do as a policymaker?
Mm-hmm.
Don't deflect this away from policy. Your job is policy. So tell me what role policy is playing in this. And inevitably he'll say nothing, but that's got to be wrong. So will the Fed get lucky? Maybe. But their problem is that they stated we're not going to raise rates until we reach full employment. Mm-hmm. That's their problem. That was not in their playbook. And inflation and higher than desired unemployment. And now they've got to figure out a way to get out of this without.
So that is the ultimate. That's the ultimate question right now on markets' minds. I mean, is the Fed in a taper trap to where it's going to be a policy error or a policy error?
Well, but that's right. What they've done, the Fed has done this to themselves. What they have done, they put themselves in a spot. Now, they didn't do it intentionally, but they should have known better. Put themselves in a spot that says, well, if we turn to fight inflation, we are reneging on our promise to not raise rates until full employment. You lose credibility. Mm-hmm. If they stick to their commitment about employment and they don't address inflation, and inflation goes up, then they've reneged on their commitment to inflation. It's lose-lose. They put themselves in a spot where they conceivably will look bad either way. So what are they doing? They're doing nothing. Mm-hmm. In order to, a lot of nothing. To avoid making a commitment one way or another and hoping for the best. Well, hope isn't a strategy as far as I'm concerned, but they're hoping for the best. So they put themselves in this dilemma that they created for themselves through what I consider to be their poorly designed new strategy and guidance that they've left. Mm-hmm. And now they're struggling to what to do. I don't think the taper matters. I'm not a big fear. I don't have big fears of taper tantrums. They ought to just do it and get on with it, because eventually they're probably going to have to raise rates. And the longer they put taper off, the longer they're going to delay raising rates and the bigger hole they're going to dig for themselves. So tapering is useful. They probably should have stopped it 6 months ago or a year ago, mm-hmm. But at least. But it's useful because it will send a signal to the markets that the Fed is concerned, which is a good, useful thing to do. But tapering and stopping purchases, I don't think will be satisfactory in stopping the continued inflation risks. So the Fed tries to hide it, to think of itself as this big risk manager. They think, oh, we're managing risk. But here they've got this huge risk of inflation that they're not managing at all. Mm-hmm. They're just hoping it goes away. And so I just think they've created a huge dilemma for themselves. And I don't believe this new strategy is going to last much longer. Mm-hmm. It's not really a long-term strategy that's going to work. They're going to have to revisit it at some point. But I think it was a mistake to begin with.
Well, so I have to ask, because it's one of the most pressing issues of the day. You were in attendance at an emergency Federal Open Market Committee meeting in October of 2013. And at that meeting, there was a blueprint drawn out as to how the Treasury Department could strategically default on treasuries in the event of the debt ceiling not being resolved, and the Fed taking the risk out of a foreign holder or a pension fund, let's say, missing an interest payment by making sure that it stayed within the purview of the Fed, and it's now, what is it, hold 25% of treasuries today.
So I guess two things. One is that the way the Fed thinks about this in general is that it's mostly about financial stability, in the sense that it would like to see doesn't want to see the US Treasury market, blow up on them.
Mm-hmm.
You can kind of understand that.
Yes, yes, you can.
But having said that, the proposals that are being bantered around that go back to that 2013 discussion, there are kind of two versions of it. One is that the Fed would buy up defaulted or non-paying treasuries
Mm-hmm.
at a market price. That's key here. Would buy them up at market prices, and hopefully with the idea that it would only be temporary and that they would refill them out. Another version of that is that they wouldn't buy them. They would just take in defaulted securities. Now, I think those are very different plans, but my concern is that this is all, for the most part, bailouts and smoke and mirrors, in the following sense. What does it mean to buy a defaulted security at a market price? Well, if there's a market price for it, why do you need to buy it at all at the market price? Because somebody else will buy it at the market price. I mean, what does that really do?
Mm-hmm.
What it doesn't do, at least in my view, and you know me, I tend to be an old troglodyte in some ways, one of the old guys, but it doesn't save the US sovereign debt, or maybe say it a different way. It doesn't really mean that the US hasn't defaulted on sovereign debt.
Right.
It still defaults.
Fitch and Moody's would follow S&P in a heartbeat.
They would still be, it would still, the US's reputation for defaulting on its sovereign debt would not be solved by these strategies, right? The reputational risk and credit risk of the US government would be damaged in either case, even if they didn't do anything.
Right.
So these strategies are not really solving the debt crisis. They're just kind of rearranging some deck chairs a bit. But the reputational risk, and what you're really afraid of, is the reputational and credit risk of the Treasury market, of the Treasury debt.
Mm-hmm.
And this doesn't solve that. It may tide things over temporarily, but so I'm not sure this is a particularly good idea.
Mm-hmm.
In fact, I'm pretty sure it isn't, because I also think that it creates a vast amount of moral hazard again, of where central banks are trying to bail out their sovereigns.
Right.
And it seems to me, didn't Argentina just try this? And hasn't a lot of countries done this before in some fashion or another, using monetary policy to protect against sovereign debt crises? It doesn't work.
Right. No, it doesn't.
So I don't think this really solves anything. There may be people in the markets that you talk to all the time, I'm sure, who would love to have this this backstop for them.
Mm-hmm.
But it doesn't solve the fundamental problem of the default by the U.S. government. And so I think it's probably not a good idea to pursue this, in my view.
Mm-hmm.
And hopefully it won't come to that. But I tell you, the case that the Fed can make, the Fed is incredibly creative. That's the word I'm looking for. Incredibly creative, and sometimes a good way, but creative, and figuring out ways to justify all sorts of interventions it could come up with that would be legal or, quote, desirable. There's no limit on how creative they can become. And this is back to where we started some of this conversation about the expanding mandate. And it's true, sovereign debt is probably more important than some things, but still, this would send a terrible signal to other countries who may have sovereign debt crises and their solution. Really want to encourage other countries to behave that way? I don't think so. Mm-mm. So I'm pretty dubious.
Well, so my final question would be: is there a way out? Is there a way out for the Fed? Is there a theoretical soft landing to where you're not going to take the S&P down by 25%, and tapering will be welcomed, and people will be rational about rate hikes? And is there a way out for the Fed?
Well, I'm not sure I know the answer to that. Maybe. I think my frustration with the Fed over the years has been that they keep digging this hole. Mm-hmm. And what's the old saying? The first thing when you're in a hole is to stop digging.
Right.
Well, they just keep digging themselves deeper and deeper into this morass of intervention, moral hazard and backstops, fiscal policy actions. And I argued back in 2010, and I still believe both these would be wise. What they really need to do is tell the Fed, A, your primary mandate is price stability. B, your portfolio should be all treasuries. And C, you need a new credit accord, which I described back in 2009, a credit accord that says the Fed does not do credit allocation, and that if an emergency comes about, it's the Treasury's responsibility. They need to be held accountable for it. Mm-hmm. And the Fed should be held harmless and protected against engaging in bad or even good fiscal policy.
Right.
Those three steps would do things like narrow the Fed's scope, protect them from digging these holes that I've been talking about, and perhaps restore some credibility and accountability to what the Fed does and is held responsible for. But expanding the mandates, doing fiscal policy, bailing out governments and creditors, all are going in the wrong direction, in my view.
Well, I share your views, Charlie, but I am also so grateful that you were able to spend so much time really tearing down and explaining in language that everybody can understand kind of what the roots are. And it's good to know that there are thinkers out there like you, because there are indeed ways that you can restore credibility and accountability at the Fed. And I want to thank you so much for spending so much time with me this afternoon. It was really a pleasure.
Well, thank you, Danielle. It was a lot of fun. Hopefully I stimulated some people to think about things a bit.
I'm quite positive you did, Charlie. I'm quite positive. Take good care.
All right. Thank you. Bye-bye.
Bye-bye. So that was pretty incredible. I have to say that was the first Federal Reserve District president I've ever interviewed, and I can't thank Charlie for giving me as much time as he did. And it's beautiful to see that he still thinks as sharply as he ever did, and that his opinions are as critical as they should be, given the tumultuous time that we're going through with really the marriage of the Treasury Department and the Federal Reserve. So I hope you enjoy it as much as I did. If you want somebody who's even more outspoken about Federal Reserve policy and much less held back, less diplomatic, if you will, then you might want to consider going back and watching a recent episode of Down the Middle that I did with Peter Bookvar. I think you'd find that to be of interest as well. As always, I want to thank you for your time, and I look forward to the next episode of Down the Middle. This is Danielle DiMartino Booth. Thank you.